Hello and welcome to the Daily Markets Brief Show. Here we cut through the noise and bring to you the most important stories that move the markets. I am your host Anurag Bansal, and in today's episode we'll talk about 4 stories. 1. Vietnamese EV giant VinFast is soon going to enter India. We'll understand what this means for us. Second, the EdTech industry is back in the news, and it is no surprise that it is for all the wrong reasons. We'll understand why. Third, we'll look at what is happening in the global markets with US inflation. And finally, fourth, we'll talk about why foreign investments in India have been reducing. Let's begin with our first story. In the last 2 episodes, I spoke about the automobile industry and its results. Today, there is new news from the EV sector. Vietnamese automobile giant VinFast is looking to launch in India. This is interesting because VinFast will look to assemble all its models locally in India. They are currently setting up a 400-acre factory in Tamil Nadu, and they will start production as early as March 2025. By the way, Tamil Nadu is almost like India's EV manufacturing hub. It accounts for over 40% of India's EV production. Now, even though VinFast is a foreign entity, this is good news for India because they plan to invest more than $500 million over the next 5 years. And in the long term, they will invest over $2 billion. This will bring foreign capital into the country and it will help boost our economy. This factory will also create over 3,000 jobs for locals in Tamil Nadu, which is great news for us. Now, VinFast's EV factory will be able to produce as many as 1.5 lakh cars every year. This will greatly boost India's dream of having 30% vehicle sales as EVs by 2030. Now, this is theory, but will the reality look the same? See, as of May 2024, VinFast had only delivered about 9,700 cars despite giving itself a target of 100,000 cars. In 2023, it sold about 35,000 cars. It has been a rough ride, but let's hope things get smoother in India. Now, by the way, if you're curious, VinFast's first model in India will cost about 20 to 25 lakhs. This will allow them to compete in the semi-premium car market. What is sad, however, is that no major Indian player apart from Tata has managed to make a mark in the Indian EV market. Now, while it is great to see foreign interest in our growing market, it is nothing compared to the impact that a homegrown EV company can make on the economy of India. Just last week, Ather, the homegrown electric two-wheeler manufacturer, announced that it would invest 2,000 crore rupees in building a new plant in Maharashtra. So far, Indian auto manufacturers are unwilling to invest heavily in EVs. But it looks like global giants like VinFast and Tesla, which also committed to invest in India last year, have a different view of this matter. Now, moving on to the next story, which is about the Indian EdTech sector. See, this sector was once the darling of investors, but it has been facing very turbulent times as of late. Byju's has already been in the news for all the wrong reasons, and I already spoke about it in the previous episode. Now, to add to it, recent reports by Entracker and the Morning Context suggest that Unacademy is under great financial stress and they are looking at options either to merge with another entity or to get acquired. Now, Unacademy is the second largest edtech giant, or rather it at least was until Byju's went down in flames. Unacademy's last successful fundraise was back in August 2021. At that time, it secured $440 million at a massive valuation of $3.5 billion. But ever since then, they have struggled to grow and become profitable. Now, for your comparison, Byju's was once valued at $22 billion. Now, however, according to Unacademy CEO Gaurav Munjal, all of this is just a rumor. He said, and I quote, "Unacademy will have its best year in terms of growth and profitability. We also have many years of runway. We are building Unacademy for the long run. Ignore the rumors." Now, even while Mr. Munjal has tried to douse this fire, there is no hiding that Indian EdTech has been struggling with the funding drought. Investments in this space have fallen by almost 90% in 2023, and 2024 has been even worse. There have been no notable deals in the EdTech space at all. Now, what is crazy is that there are some loose similarities between what happened in China's EdTech sector in 2021 and what is happening in India right now. See, right when the Chinese EdTech industry was booming, the Chinese government cracked down on it. They decided to ban private tutoring for K-12 students and forced all companies to become non-profits. By the way, K-12 is a short form for kindergarten to 12th standard. Now, the Chinese government did this to reduce the burden on parents and students because both were under a lot of stress to spend a lot more money to get good grades. Now, because of these changes by the Chinese government, the EdTech firms also could not list on the stock exchange. This effectively wiped off billions of dollars in value. In desperation to stay alive, some of the Chinese EdTech companies tried pivoting to unrelated areas. They tried getting into live streaming and adult education, but it was all in vain. In fact, the way they were doing these live streams is quite funny. On the surface, they could be teaching you English, for example, but in between their live stream, they'll end up plugging products like meat and ask you to buy it. But either way, whatever the Chinese government did was enough damage for the companies to either shut shop or scale down massively. Now coming back to India, after the pandemic, the EdTech sector has faced two very major challenges. First, companies have found it very hard to generate revenue from online courses. This is mainly because people have gone back to in-person learning. Second, EdTech's backup, which is offline coaching, is a capital-intensive business. And as things stand today, investors don't seem to have trust in the EdTech business to help them out with this capital. It'll be very interesting to see if the Indian EdTech also follows the exact same path as what Chinese EdTechs followed when they pivoted to some other unrelated things. So far, however, there are no signs of this happening. I'll cover this space as and when there are more developments. Moving on, let's talk about US inflation and the global markets. See, in a previous episode, I had discussed the US inflation data and why it matters to us. In May, the US Personal Consumption Expenditure or PCE data came out and prices stayed at the same level as in April. They were 2.6% higher than a year ago, and this is good news. Now here is why this matters. The US Fed is trying to walk on a tightrope. But first wait, if you're new to the market and are already wondering why the hell does this matter, let me quickly explain to you. See, in a very loose sense, the US Fed's job is to determine how expensive money is for banks. If the money is too cheap, banks lend a lot more of it out than they usually should. If they lend more, people go on a shopping spree and everything becomes more expensive. On the other hand, if money costs too much for banks, they don't lend much even if people have productive uses for it. So people spend less, business owners invest less, and the economy eventually suffers. So you see, it's all a very vicious cycle. Now towards the end of the COVID-19 pandemic, the US was caught off guard by dramatically spiked inflation. From 2022 onwards, it increased its interest rates 11 times from 0 to 5.5%, which is a 22-year high. It looks like it worked. At the peak in 2022, inflation stayed stubbornly high at 6 to 7%. Now it is under 3%. It is still above the 2% rate that the US Fed is targeting, but still there is great progress. Now here is where the tightrope walk becomes difficult. On one hand, inflation is becoming harder to tackle. It is not falling as fast as it was, and in fact, it seems stuck slightly below 3%. And on the other hand, the economy is starting to take a hit. American GDP forecasts are saying that economy is slowing down. So the risk is that the Fed may be too late to cut rates and that the US economy would have already slowed and unemployment might have become very high. So it's a very difficult time to be the Fed chairman right now. The Fed is holding interest rates steady for now. At a recent central banking forum, Jeremy Powell, the Fed chairman, said, and I quote, "We've made quite a bit of progress in bringing inflation back down to our target. The last reading and the one before it, to a lesser extent, suggests that we are getting back on the disinflationary path. We want to be more confident that inflation is moving sustainably down towards 2% before we start the process of reducing or loosening policy." Now, why does this matter to you in India? Look, as someone said, it is the dollar's world. We are just living in it. If the US interest rates remain high, the dollar will remain in short supply. Because we deal in rupees, dollars shall stay more expensive for us, which means imports will stay costly. And that is bad news for anyone who imports a lot. A stronger dollar means that emerging markets become less attractive for foreign investors. Even if a company gives you fantastic returns in rupees, if the rupee falls against the dollars, these returns might not mean too much. So FPIs may either pull out money from India or they might reduce their investments. If US does cut interest rates, it is good for us, the markets and your investments. Now talking about India, inflation has taken a similar path in India and the US. In the RBI's meeting last month, it kept interest rates unchanged at 6.5% for the 8th time in a row. Interestingly, however, 2 members of its monetary policy committee voted for a rate cut. According to them, the monetary policy works with a lag, and if we do not cut interest rates for now, growth may suffer 1 year from now. Interestingly, speaking at an event, the RBI governor said, and I quote, "There is one game where if you make a wrong move, you are finished. That is the game of chess. Therefore, as in the game of chess, we cannot afford to make any mistake or policy error or any wrong move." We have to play our game and decide our monetary policy actions primarily driven by the inflation numbers and the outlook that we have. Now moving on to the next story, we'll understand why foreign investments in India have been falling. Every country in the world makes a business pitch to their investors to raise capital. America says things like, hey look, we are huge and we are rich. We'll give you money to buy whatever you're offering. China says something like, we are even bigger and we get things done. We've built our country around making things for the world, and if that is what you want to do, we'll do it. Now under PM Modi, here is what India pitches to others. We want you to make things here for the world. We are cutting taxes, we are simplifying our laws, and if you want to make stuff in India for India, we'll give you land and subsidies as well. And we're making world-class infrastructure so you can also ship out whatever you make. Now look, that's not really a bad pitch, but somehow it does not seem to impress as many investors as one would hope for. In 2023, FDI or foreign direct investments into India fell by 43%. Now even though we're the world's 5th largest economy, when it comes to drawing foreign investment, we come 15th. Lately, in fact, more money is leaving the country than what is coming in. Now, without investment, we simply cannot scale up manufacturing in the way we would ideally want to. In FY 2024, manufacturing was just 12.84% of our GDP. That is the lowest it has been in 1 decade. So what's really happening here? A new article by Josh Feldman and Arvind Subramanian has a theory around this. They say that investing in India can give you great returns, but it also comes with special risks. If you want to take a long-term bet on India, there is an off chance that on any random day, your investment will suddenly lose all its value. And that thought is scaring investors. In their article, Feldman and Subramanian point to 3 habits of our government. First is that the government supports national champions, or homegrown companies in other words. Now from the government's perspective, that practically makes sense because large companies export a lot and can bring a lot of money to India. But if you as an investor want to invest in an industry that also has a national champion, then the playing field could be really against you. Second, there's a bit of arm twisting that happens. See, the Indian government is very powerful. Its many agencies can upset your business on a whim. An ED raid might hit you on any given day, or the government might suddenly tell you that there is a brand new tax you have to pay for something that happened 5-6 years ago. This way, even if a business idea looks great today, it might not really be. Third, your supply chain may fall apart overnight. A big part of any business is figuring out where to get your raw materials from. If the best supplier for something is located abroad, ideally you would want to import it from there. But there is a risk that the government can suddenly impose a big import duty on your supplies. In such cases, you will suddenly have to rethink all of your operations from scratch. Now, because of this, if you are ever taking a long bet on India as an investor, there is an unspoken challenge that at any time the government can make life very difficult for you. And this is largely why long-term foreign investors have been a little shy to invest in India. That's all the news I have for today. I hope you found value in this, and I'll see you in tomorrow's episode.